Mike Tedeschi, Wealth Management Advisor, Perspective Wealth Planning with this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We'll take a look at the U.S. dollar as well as commodities. In this week's video, we're going to take a look at the breadth readings from the largest 100 companies in the Nasdaq to the entire Nasdaq Composite Index. The spread's actually pretty wide and what that could mean for us moving forward. And we'll also talk about how consistent this market has been this year. First and foremost, let's start with the S&P 500. As you guys can see, we continue to make new all-time highs. We have just continued to grind higher all year long. New high after new high after new high. We continue to say it every single week. There is nothing bearish about this chart whatsoever. The technicals still look fantastic as we keep pushing and making those new highs. Nasdaq's gone 4 days without making a new high, is right there just about at that all-time high zone. Look for a continuation over that 15,200 level, clearly over that breakout zone from back in June. Index looks solid. When we take a look in at the Dow finally got its new high. We had our breakout yesterday off the backs probably of the infrastructure bill, money going into a lot of those down names because of that passage. But it really doesn't matter why. All we're looking at here is the charts, and we clearly took out that high from back in May and finally broke to new all-time highs. This is a very solid chart. After, again, a few months worth of basing, we finally get that follow-through and breakout here to the upside. That looks really, really good. When we take a look in at the Russell, we're still trapped inside that range. As I've said before, I'll say it again, I think it's really, really important what happens here in the Russell. If the Russell breaks down below this box, i.e. underneath that 2050 zone, that would be cause for concern. If it breaks above that 2360 level, that would be a very good sign for the overall market. And if the Russell continues to stay trapped inside this range, it's not a problem. As you can see, the other indexes are pushing and making those highs. This just had such an incredible move from the last portion of last year that we've really just been kind of digesting those gains for quite some time. This is a really long box at this point in time, about 8 months. So the direction that this breaks moving forward is going to be very important. But again, it can just trade sideways for quite some time and has been doing it for the majority of this year. So we'll continue to keep our eye on it, but not a whole lot to be worried about over there at this moment. Now we come in here, we look at the U.S. dollar. The U.S. dollar still has not taken out the previous high at that 93.50 zone. It's had some strength here over the last month or so. If you look at this, it did technically put in a higher low on that pullback back in May and June, so the bears were not able to break it lower, but the bulls have not been able to break it higher. We are really just trapped inside of this range. We've been there in the entire year, and of course we're towards the top end of the range, which has weighed on some of the commodities, especially the precious metals. We'll take a look in there at gold. Gold got smashed last Friday, falling all the way down to that key 1675 zone. Those were the lows from back in March and April. And you'll see on this candle, really large wick came down, tested that support zone, and flew right back up. The problem now is, can it get back up over that 1760 level, which was the important low from June? It's also the breakout spot from back in April. If we stay below that 1760 zone, that does put this space under a lot of pressure. So we have clearly lower highs and lower lows at the moment, still in the context of a multi-year breakout that we saw last year up near all-time highs, but we have not accomplished anything in a year, right, of just kind of sideways to down action there out of gold. This level is the most important on the chart from the short term. You can see the importance again from March and April. You can see it from April and May of last year as the area that we broke out from and held before pushing higher. If gold loses this zone, it loses that breakout from last April. That would be a big negative for the space as a whole. Silver, which had looked much better than gold for the majority of the year, right? You notice it was a flat top. Gold's chart is going like this, whereas silver's chart was more trading in a sideways range. It's still technically in that sideways range, but up until the last week or so, we had a series of higher lows still in place. then we got this breakdown here, and then we got the next breakdown. It did hold the important 22 level. That is the important support zone from last October and November. Underneath 22, that would be very bad for this market, because we can look at this as a year of sideways trading, right? Back up and down inside this box. Whichever way this box breaks, we should see continuation and follow through. So under 22 really breaks the silver market here. As long as it holds inside that range, again, it's just digesting, kind of the same way the Russell is. We cannot, make a decision one way or the other. We have to see which way that box ultimately breaks. When we look at platinum, platinum broke underneath of that $1,000 level, but immediately bounced back up. The really important is that spike low back at 921. Underneath 921, I think it undoes the majority of what we have seen out of the platinum market. This has not acted well in comparison to some of the other precious metals, but it is still holding over that important psychological $1,000 level on a weekly closing basis, assuming it does not fall below it by the end of this week. So when we look at this on a weekly chart, all right, we fell right into that zone, and now we've gotten that bounce back up. Again, that's the really important level in on platinum. We're watching it very closely to see what happens here, but this has not been what you wanted. If you go back a few months, we're pushing into that 1,300 multi-decade potential breakout zone, and just the rollover and failure is not great. Any more downside movement there in this space would really kind of negate a lot of the work that it's done. We're looking at palladium. Palladium's still holding over that key 2,500 level. It's just chopping around and spending a lot of time in between that 2,500, 2,800 level. Really would like to see that continue and follow through here to the upside. I would say this still looks like the better of the precious metals charts, right? We still have higher lows in place. We have some lower highs, but really we can look at this as a wedge coming from down below. How this resolves, you have a higher propensity for it to resolve to the upside because we came from below, but we're going to continue to watch that. Basically, a move underneath 2,500 really does kind of break this chart as well. We come in and we take a look at crude. Crude, we've talked about these levels. I'm zooming in so you guys can see 65, 75. That has been the area that we talked about all of last year and into this year. All right, that 65 is a major resistance zone. We broke through it. The last end of that zone ends at 75. We tagged it, and we've started to fall back down. Right, oil market essentially at this moment in time is trapped between that 65 and that 75 zone. Right, it's trapped inside this range, and we could stay here for quite some time. Again, we've had an incredible run out of oil here over the last year. We could trade sideways for quite some time. How this breaks, if it up over that 76 zone, that would be very bullish for the space. If it falls underneath that 66 zone, now we're running into making lower lows, and we really have that next area of support down at 58. So we're watching this very closely. It's an important level, but we don't have confirmation either direction. The takeaway from all of these commodities that we're looking at right now, we don't have resolution in terms of where that next move is going to be. All right, they're all trading inside these important zones, near important areas. Copper's the same way. When we look at it, 4.2 to 4.6 trading inside that zone, right? We back this up and we look at it on a monthly time frame. It's up near all-time highs. That's not a bearish thing. It's a question of whether we're going to see that follow through and break higher or not. If we fall underneath that 420, again, a lot of this potential work that we have put in here might need to be negated. I've seen people talking about this as a potential head and shoulders. Here's the thing with the head and shoulders pattern. It doesn't matter until you break the neckline. So we need to fall underneath 420 for that to even be considered a valid signal. So again, we're watching this space as well. So takeaway, we're at a lot of key zones in both the US dollar, commodities as well. We don't have a clear answer in terms of where our next move goes. All of these things have come from lower. They have a higher propensity to make a break to the upside off of those technical patterns. Doesn't mean that it's going to, and we're going to continue to monitor these until we get our resolution. The market has just consistently grinded higher all year, and without a 5% pullback, we've now gone 189 days. I actually think this data set was a couple days over, so I think now we're like 192 days without a 5% correction. Right, and the number of 52-week highs we've had for the year is 43, 44 in that zone. These are historic. And areas of strength and low volatility that we're seeing. When we look at what that data means for the long term, it's actually a little bit of a concern. When we look at the S&P 500 going 189 days without a 5% pullback, there are a good number of signals here, so it's a decent enough data set to actually garner some value from. Right, 1 to 2 weeks later, the market was negative a high percentage of the time. Not every time, but a high percentage of the time. It struggled over the next couple of months, did real well a quarter later, and then when we got out to a year, we were about 50-50 in terms of where we were, whether we were going to be positive or not. Now, when you combine that data set with looking at 40-plus new highs in a 52-week session through November of the trading year, we struggle a lot less in the short term, and we do have a much higher percentage positive, 6 months, a year later. So when we think through this data set, look, we continue to make new highs. Making new highs is not a bearish thing. We talk about it all the time here. But going a long period of time without any sort of meaningful correction, eventually the train has to kind of run out of steam. And historically, we have seen some weakness in the short term, but mid and long term out, it hasn't affected those long-term trends. We usually get a couple of 5 to 10% corrections every single year. We haven't gotten one this year, and all the way through November, it's a pretty rare thing for that to have happened. So we're going to continue to monitor this, but again, until the market actually starts to pull lower and stops making those new highs, there's really nothing bearish about it. We can look at these data sets and look at what happened historically. But I mean, we got data sets in here, looking at things going on in the 1950s and 60s, right? 1920s. How much money were they printing back then? Some things have changed, right? The amount of money that's being printed could make these 50, 80, 100-year-old data sets not hold nearly as much weight as they once did because the rules of the game have legitimately changed. Now, we talk a lot about breadth, and this is the last thing I want to look at this week. I have talked a lot about how top-weighted the market has been, and this is a very good visualization of seeing that. We're comparing the Nasdaq 100, which is the 100 biggest companies on the Nasdaq, versus the Nasdaq Composite, which is made up of about 2,500 stocks. All right, the difference between the two is huge. Less than 40% of the Nasdaq is above its 50-day moving average, while 70% of the Nasdaq 100 is above its 50-day moving average. That is a very large spread between the Nasdaq and the Nasdaq Composite. We are looking at a historic spread, one of the biggest differences between the Nasdaq and the Nasdaq Composite in the last 20 years. When we look at both the Nasdaq and the Composite, and we look at the data set here, we run into some struggle again 1 to 2 weeks out in both of them when we see these kind of readings. But if you go out 6 months to a year, on both, it is very, very, very positive. So historically, that gap has kind of closed itself, and with the leaders leading, it lifts all boats higher, kind of thing. That has historically been what that data set has looked like. We're going to continue to pay attention to it, and as I've continued to say in these videos, I mean, we have a very top-weighted market with some of those extremely large companies, and that has made a difference when you take a look at what's going on under the surface versus what is just going on with the Nasdaq 100. We do not want to see that spread widen anymore, because if we start seeing 30 and 20% of the Nasdaq Composite Index above their 50-day moving average, there's the propensity for that to pull everything down. So we'll continue to monitor that. As always, I hope you guys have yourselves a fantastic week. If you want to discuss anything related to the overall markets with me, feel free to reach out at mtedeschi at perspectivewealthplanning.com or give me a call at 814-580-9881. I'll see you guys next week.